There were very few weekly key reversals in the markets I follow, all told last week. There were weekly key reversals down in NYMEX WTI crude oil, ICE Brent crude oil, and ICE gas oil as well. However, interestingly, there were no key reversals down in the stateside energy products, that is NYMEX heating oil and NYMEX RBOB, the gasoline contract. This still indicates to me, as I've repeatedly said in recent weeks, indecision, close to the top of the market. Now I will look at these shortly, but I wanted to just take a quick look at the singular weekly key reversal up first. Now we had a weekly key reversal up in Chicago lean hogs last week. This was interesting, as 6 weeks ago we had a weekly key reversal down. That failed. The reason for the failure was a lack of enough bullish incentive to punch up through the important 50% projected Fibonacci line at 109.73, and there just wasn't enough behind it at the time to pressure it lower. And the weekly key reversal was creating an area devoid of much bearish pressure, bar the 50% Fibonacci line and the lesser 38.2% projected Fibonacci line at 107.30. This time with the weekly key reversal up, we've seen a strong resurgent move higher over the 50% projected Fibonacci line and seemingly little in the way until the 100% projected Fibonacci line at 120.02. I say seemingly as there is something up here from way back. On continuation charts you will find a big gap from about 116.35 up to 129.70 area dating from July 2014, and that is worthy of noting. At first glance, it seems the market is willing to try and fill that gap, well, up to at least the 100% projected Fibonacci line at 120.02. I'd now like to take a look at the crude oil contracts and gas oil. I'll concentrate on Brent and gas oil as I follow these more closely than WTI. Brent has a complex series of patterns developed and developing. There is a sideways triangle from March to April, a broken but still seemingly effective broadening formation, right angled ascending, from February, a triple top formed over May as well. However, what is happening right now is that the market last week broke down and out of the April to May bull channel and got itself caught in the lower trend line of the broken broadening formation, which whacked it higher like a table tennis bat and ball, to now start running along the underside of the bull channel, currently at 69.36. However, this batting back up action has not been enough to negate the weekly key reversal down from last week. Well, not yet at any rate. This is because we have strong resistance just over 70 even, as you can see since March, partially prompted by the April 2019 to date downtrend and partially by the 2020 high at 71.75. That is where we're at. There's no follow through lower, but not a clean response higher either. As for gas oil, a similar but more bullish situation. Overhead, we have the significant 50% Fibonacci line, the June 2014 April 2020 move at 562.75, which along with the congestion zone 562.75 to 596.5 from September to December 2019 have together capped the market. However, here we also have a bull channel, currently 547.75 to 580.5, that has not, repeat, not been broken. Yes, it has been pierced, but there has not yet been a close outside it, unlike Brent, and which currently contains the market in its striving to move higher. This one definitely looks more bullish, but please remember this: if either or both of these markets follow on to their weekly key reversals down, then we have a bigger issue to address. You see, if that happens, then we will have some potentially very large double tops formed over the whole of 2021 to date, Adam and Eve types if you want to be exact. That doesn't look likely right now, but it is worth paying close attention to, especially if Brent starts pushing or not pushing through $70 and gas oil does the same at $563. I am happy to share my videos, various charts, and answer any questions with anyone who is interested. And with that, I'll finish this section from London. I hope you found these comments useful.